I think there is no such thing as a neutral rate. I mean, if you take a look at the Fed funds rate over the last 10 years, it's averaged 38 basis points. If you look at it since the beginning of this century in the year 2000, it's averaged 171 basis points. If you look at it from the beginning of time in 1954, it averaged 480 basis points. There is no such thing as this rate, this ephemeral rate that they're talking about. I have no idea who came up with it, but the key point is, if you're running an economy which is at 38 basis points for 10 years, and you jump the rate fivefold, which is what has happened, to assume that all of the people who financed the trillions of dollars that were financed at this lower rate can automatically adjust to the higher rate without any negative consequences is, I think, a major mistake.
All right.
In addition to which, I'm sorry, but if you shrink the growth in money supply, which is roughly 6.7% since the beginning, again, of this century, to 3.8%, you know, you're doing two things. One, you're taking money away, and two, you're making the money that is available very expensive on a relative basis, and that's a very negative.
Those numbers you just cited were the growth, I think, in the money supply, right? Is what you're talking about, from 6.7 to 3.8. Kathy, jump in here. You know, as Dom pointed out yesterday, Sri is a highly respected analyst, but has leaned toward the more glass half empty side in many cases.
Yeah, I think that it is a good point that, you know, even the Federal Reserve admits they're not really sure what the neutral Fed funds rate is, but they're going to go very gradually, and they have a risk management approach, which Chair Powell has outlined, and they're going to watch the incoming data and financial measures as well to kind of guide them. But I think the fact that they're finally getting to short-term rates that are no longer negative, it's just a reflection that we're no longer in a crisis. The post-crisis economy is well behind us. You can see that with a number of indicators. The labor market particularly is red hot and has showed no signs of slowing. So I think the Fed is being prudent, taking a little insurance tightening here, maybe a little bit more next year. We look for one more rate hike this year and three more next year. And I don't think that necessarily derails the economy or sends us into recession. We actually see the recession odds rather low, about 20% right now on various measures that we look at.
Kathy, it's Dom here. One of the things that we want to kind of highlight is this idea that the Fed is on a path right now that it sees at least the economy doing okay enough to kind of go through this rate normalization process. What exactly would they have to see outside of a really bad jobs picture that would make them kind of get that pause back in their playbook going into 2019?
Well, I think they'll look at various measures, you know, key leading indicators and financial market variables as well. But not one indicator itself will really dictate. They're going to look at the whole swath of readings to try to get a sense of where things are headed. And right now, the leading indicators, coincident indicators that we look at and the Federal Reserve look at point to continued sturdy growth. You know, we have to remember that even if the economy completely stalled, you're still getting about half a percentage point of injection from fiscal stimulus. So you can absorb some of the negative impact from tariffs and still, with this domestic economy doing strong, you're still on pace, we think, to get 2.5% growth next year.
Dick, we're basically out of time. I'm going to ask you to put a percentage bet on a recession by the end of next year.
I'd say 60%.
60%.